What if I told you the biggest mistake most homebuyers make has nothing to do with the house they choose, but everything to do with the number they choose to believe they can afford? We're about to break down how to buy a home without wrecking your finances, your sleep schedule, or your Saturday brunch budget. Here's the thing nobody tells you at the open house. That dreamy listing price is just the beginning, and the real cost of homeownership is hiding in every corner like a bad roommate. We're talking property taxes, homeowner's insurance, HOA fees, maintenance, and the occasional water heater that decides to quit on Christmas morning. The first rule of not going broke buying a house is understanding your debt-to-income ratio, which is basically the financial world's way of asking how stretched thin you already are. Most lenders want your total monthly debt payments, including your new mortgage, to sit at or below 43% of your gross income. But staying closer to 36% is where you actually sleep at night. Now, before you let a lender's approval letter turn into your new personality, remember that getting approved for $500,000 doesn't mean you should spend $500,000. Focus obsessively on monthly cash flow, not the headline number, because that mortgage payment shares a bank account with your groceries, your car insurance, and your ambitions. Let's talk down payments, the part where everyone either panics or pretends they've been saving diligently since 2011. The golden rule used to be 20% down to avoid private mortgage insurance, but the modern home buying toolkit has expanded dramatically, and you have more options than your parents did. If 20% feels like you need to rob a moderately successful lemonade stand, conventional loans now allow as little as 3% down. FHA loans allow 3.5%, and VA and USDA loans can take you all the way to zero down if you qualify. There are also down payment assistance programs hiding in plain sight at the state and local level that thousands of eligible buyers never even bother to look up. Gift funds from family are also fair game on most loan types, which is either a generous lifeline or a slightly awkward Thanksgiving conversation, depending on your family dynamic. Just make sure you document that gift properly, because lenders will ask for a paper trail the way your mom asked for a thank you note. Once you've got your down payment strategy locked, the next battlefield is mortgage shopping, and most buyers are leaving serious money on the table by only talking to one lender. Getting quotes from at least 3 lenders, including banks, credit unions, and mortgage brokers, can save you tens of thousands of dollars over the life of a loan, which is the kind of money that funds actual vacations. When comparing offers, don't just stare at the interest rate like it's the only number that matters, because closing costs can vary wildly and quietly swallow thousands of dollars before you even get the keys. Ask for the loan estimate form from each lender and compare the annual percentage rate, which folds in those fees and gives you a truer picture of what you're actually paying. You'll also hear about buying mortgage points, which is essentially prepaying interest to lower your rate. And this can be smart, or it can be the financial equivalent of paying extra for a gym membership you'll cancel in March. The math only works in your favor if you stay in the home long enough to break even, typically 7 to 10 years. So be honest with yourself about how long you're actually planting roots. Here's the part where we get a little uncomfortable. After closing on a home, many buyers are so wiped out financially that a single broken pipe becomes a genuine crisis, and that is a catastrophically bad place to be. Before you close, make sure you have at least 2 to 3 months of housing expenses sitting in an emergency fund, untouched, non-negotiable, and definitely not secretly earmarked for furniture. Zoom out for a second and remember that real estate, like most assets, moves in cycles. And the neighborhood everyone's fighting over today might cool off by the time you're ready to sell. That doesn't mean don't buy. It means don't stretch to your absolute maximum and assume appreciation will bail you out, because the market doesn't owe you anything. The historical lesson here is beautifully simple. Buyers who stay within their means, build equity patiently, and avoid panic selling in downturns come out ahead almost every time. Discipline and boring math have quietly made more millionaires in real estate than any hot tip or perfectly timed market move ever did. So the philosophy here isn't about finding the perfect home at the perfect time. It's about making a rational, well-prepared decision you can sustain through job changes, rate fluctuations, and whatever chaos the next decade decides to throw at you. A house you can genuinely afford is an asset. A house that owns you financially is just an expensive source of anxiety with a nice kitchen. And whether the market dips after you buy, your rate looks high compared to next year's rates, or you find a scratch in the hardwood on move-in day, the prepared buyer shrugs and keeps moving forward because they built margin into every decision. If you like help navigating real estate investing, connecting with contractors for home projects, or finding the right lender for your situation, check out our links in the description below.